Hello everyone, welcome back. In this video, we continue with the chapter 21. This is for accounting 312. So in this video, I want to focus on the first technique of the discounted cash flow. As I said, discounted cash flow is the general method. So discounted cash flow is the general method. Under this general method, there are two specific techniques. So they are kind of like a cousins, right? Or you and your sibling. They both use discounted cash flow concept, but they have a lot of difference. So the first one we call it net present value. The second one we call it internal rate of return. So let's look at the first one and then look at what's the meaning of discounted cash flow. So discounted, okay. So we said there are four techniques. So the first two, they rely on discounted cash flow. The first two, they rely on discounted cash flow. And we have a net present value. We have internal rate of return. So this is first one. Second one, we have the third one called the payback method. And then the fourth one, we call it accrual accounting rate of return. So your goal is for these techniques, know what's the meaning of each technique, what's the meaning of each method, and then second, get the number, calculate the number. I know you like this, so I don't really worry too much. Just to be very careful, there are something I want to point out in this video, and then be careful in the exam. Discounted cash flow. Let's read this loud together. Discounted cash flow. There are two things in this name, okay? You know, I always say here, as English is my second language, but I think the name makes perfect sense. First thing is cash flow. It is cash flow. Why I keep saying cash flow? Because later when we do our fourth one, we do accrual. So if you have learned financial accounting, you know your operating income is different from cash. Okay, so that's very important. When we do discounted cash flow, we focus on cash. We focus on cash. We do not worry whether the cash is from your operation, whether the cash is from selling your equipment, or whether it's from your other activities. As long as it's legal, right? You cannot say here you are going to rob the bank. That's not right. But as long as it's legal, we put that in our consideration. We focus on cash. We focus on cash. We don't worry about accrual. Don't worry about prepaid or whatever. We focus on cash. We focus on cash. Second thing is discounted cash flow. Discounted cash flow. What's the meaning of discounted cash flow? As I said in the first video, I assume you know general idea, the time value of money. So if you don't know, it's okay. You know, if you don't know, it's fine. Just read textbook and then get some background video. General idea is, okay, so now is today, right? T equals to 0. Time is now. And then you have next year, T equals to next year. You have two choices. It's either you get $100 today or you get $100 next year. I believe you all know the answer. You want to get $100 now. Why? Because of time value of money. $100 now worth more $100 than next year. Many different reasons. First is you can invest, right? Even you put in bank, at least it generates. I think the interest rate is not that high, but I just make a number. At least it's 10 cents, right? So at least, so $100 today worth $100 and 10 cents next year. Or you put in the stock market, you can also get a return. And then it also has some risk factor considered. So even it doesn't earn money, even it doesn't generate money, you still want to get $100 now. Who knows whether that somebody give you $100 next year, yes or no. So many different reasons from your finance classes. Believe you learned more details there. We said the discounted cash flow is we take care of the value, the time value of money. We put the time value of money. So It's not fair to compare $100 now with $100 next year. It's kind of like you compare apple with orange. It's kind of like you compare apple with orange. So what should you do? You have to convert the orange to apple, right? And then you compare this apple with that apple. So how do we convert the $100 from next year to now? We give it a fancy name. We have to discount it back. We have to discount it. So this is the present value. This is the future value. We have to discount the future value to present. We have to discount the future value to present. How do we discount? The present value is the future value times the factor, times the discount factor. You say, what is discount factor? That's why we said you have two tables. You have table 2 and table 4. What's the difference of these two tables? Table 2, we call it a present value of $1. Present value of $1. Table 4, we call it a present value of annuity $1. Present value of annuity $1. So what's the difference? Table 2, we use it if you just have a one-time transaction. If you just have one-time transaction, somebody will give you $100 just one time next year, or 2 years ago, or 5 years ago. No, 2 years later, 5 years later, or you will get a lottery, 10 years later. So you just have this one-time transaction. Then we use table 2. What's the meaning of an annuity? It's annual, right? So you do something every year. You make your car payment, you make your mortgage, you make your student loan, you get your retirement. So those things are annuity. Somebody will give you $100 1 year later, another $100 2 years later, another $100 3 years later. In this case, we will use table 4, annuity. Okay, so how to make sure and how do we get numbers? I'll show you some specific question, but you have the period, it's 1 year, 2 year, 3 year, and then you also have the discount rate. And then you use the period, you use the discount rate, you will get a discount factor. You will get a discount factor. So let's look at some questions. I'm not going to do it too much. I'll just give you the handout. You can look at the my work later. But email me if you say, hey, Professor, I don't have any foundation with this thing, then we can talk more. But I think if you got the idea, you should be fine. Time value of money, we said you want $100 now, right? You don't want to have $100 next year. $1 discount is you will get $500 next year. You will get $500 next year. So this is just a one-time transaction. We use table 2. We use table 2. Annuity, you will get a lottery every year. You earn $500 for 10 years. So we use table 4. We use table 4. Okay, as I keep saying, there are kind of two specific methods. They are kind of like cousin siblings. One is net present value. One is internal rate of return. Both they use the required rate of return, which is called RRR. So I'm not going to read, but this is the minimum accepted annual rate for the investment. We use that one to discount our future value. It also counts the discount rate, hurdle rate, cost of capital, opportunity cost of capital. What's the meaning? You want to borrow $1 million from a bank, right? A bank will not give you money for free. And then bank said, okay, you want to borrow $1 million, no problem, but you have to pay me 10% as the interest rate. That 10% will be the minimum acceptable annual rate. Why? Because if you invest something and the return is lower than 10%, if it's 8%, then you will lose money. You cannot even pay back the interest. So our required rate of return has to be 10%. Okay, so we look at the first one, net present value. We look at the first one, net present value. I want to explain the name. I want to explain the name a little bit. It's called net present value. You will heard a lot of this called NPV analysis. NPV analysis. Okay, two important factors. Two important factors. First one, it is the present value. I believe now you already know what's the meaning of present value. You discount all the future flow to the present. Second, it is the net present value. It is the net present value. So you can see there are two steps to do. The first step is you discount all the flows to present value. And the second is you net. You say, why net? Because you have a cash inflow, you have a cash outflow most likely. So you net those inflow, outflow, you will get a net present value. It's one more time, it's focusing you on cash. We look at cash inflow, we look at our cash flow, and then we use the required rate of return to discount all the future cash flow to the present. I practice one with you, and then you do the case two by yourself. Okay, I believe you do the case two by yourself. I do the case one. You are buying a laptop at 1,000, so useful life is 1 year. The way I do it is I like to draw a timeline kind of like this, and then your present time is always set as 0. So that's your present time. And then if you have a 1 year, 2 year, 3 year, 5 year, kind of like that, you can put t equals to 1, 2, 3, 4. But this is just 1 year, so I just put t equals to 1 here, no residue. So you are buying a laptop 1,000. What does that mean? You have to spend 1,000 now, right? You have to spend 1,000 now. So you have a cash outflow. You have a cash outflow 1,000. So we use this negative as outflow. You have a cash outflow 1,000 now. And you have a cash outflow 1,000 now. Because of this, your next year operating income will increase by 500. So next year you will get cash inflow. So we put a positive, it's inflow 500. Required rate of return is 10%. Should you do it, yes or no? I mean, even without learning this, you should know it's not a good deal, right? But let's just practice. Let's practice. How do we get our NPV? How do we get our NPV? We said the first is we discount, right? We discount. You cannot say 1,000 minus 500. That's not right. We have to discount this 500 to our present value. How do we discount? It's a one-time transaction. So we just use table 2. We use table 2, 1 year, 10%. Okay, 1 year, 10%. You said, how do you get 1 year, 10%? It's 1 year and the RRR is 10%. So 1 year, 10%. Discount factor is 0.909. So how do we get our present value? Present value is your future value times the factor. So it's your 500 times 0.909. I have no idea. Sorry, I have to cheat. Sorry about that. Let me look at my solution. Okay, come on. Let me look at my solution. So how much that will be? It will be 454.5. 450.45. So this is the discounted cash flow of 500. Now we discount it back. We got 454.5. Are we done? Is that our net present value? No, we have to net, right? We have to net. So we have to get a net present value. we have 1,000 outflow, we have 454.5 inflow. So what is the net? The net present value will be da, 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 will be how much? Will be negative 545.5. Will be negative 545.5. Our rule of law, our rule is we compare the NPV with 0. So we said at least the NPV has to be 0. If it's larger, that's better. But if it's larger or the same as 0, we take it. For this case, it's definitely we don't take it because NPV is negative. Okay, so if this is in your exam, I said, what's the NPV? You tell me it's negative. And do you take it? Yes or no? No, don't take it. Okay, so that's this video. As I say, I don't want to make a too long video. You practice case 2 by yourself. You check your answer with my video. And the next time we talk about case 3, and then we talk about the other factors, and then we go to the second technique, second method, IRR. Okay, I'll see you next time. Let me know if you have any question.